Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended August 2nd, 2017. We saw about $8.2 billion enter the conventional fund business. We'll talk about ETFs as well during this presentation. But $8.2 billion come into the fund business. But it was really, it's kind of a little bit misleading, those headline numbers, because what we saw was investors actually sour a little bit on equity funds. And this is actually after we saw, I really saw some concerning news. Basically, we saw FANG stocks taking a little bit hit late in the month, and people were concerned about the high-flying tech stocks maybe being a little bit overvalued. We heard that the skinny repeal of Obamacare basically did not pass muster in the Congress. Republicans weren't able to push that through, and we saw a shakeup in the White House. And I think this kind of soured people on investing. They just want to take a step back and see what's going on, especially after the market's been doing so well. I think they were just taking some of those hard-won profits off the table. But let's go ahead and take a look at the macro groups to see how this panned out into flows. We saw about $1.7 billion come out of the equity funds. Taxable bond funds lost about $184 million. Nothing really to talk about there. We saw inflows into muni bond funds, but only to the tune of about $90 million. And then we saw money market funds take in about $10 billion. So that's really where all the flows were, and why I was saying it was a little bit misleading headline number. Let's go take a look at equity funds to see how it panned out on what worked and what didn't. Basically, if we take a look at equity funds, we saw they lost about 0.21% for the week. It's first week in four that they've actually seen downside performance, and that caused another outflow, $1.7 billion. It's the sixth consecutive week we've seen outflows from that group. As we've been talking about in the past, there's been a dichotomy between domestic equity and non-domestic equity. So let me give a breakout there. Domestic equities funds saw about $2.4 billion in outflows, 31st consecutive week that we've seen outflows out of that group. So really it's starting to get a landslide there. They suffered about a 0.46% loss return, so there was a decline there. And then when we take a look at non-domestic equity funds, we actually saw that they took in about $663 million. That's kind of been the story as of late. This is the fourth week in five they've actually seen net inflows, and they had a return of about 0.30% return. That was on the plus side. If I break this out, we saw large cap funds actually lose about $1.2 billion, and then when we take a look on the international side, international equities versus global equities and, of course, domestic equities. But international equities actually took in about $696 million. So, again, it was a good story as far as non-domestic equity funds went, but kind of a wipeout again for the domestic equity funds. I won't say wipeout, but certainly a continuation of outflows. Let's take a look now at what happened in the ETF universe on the equity side. We saw for the second consecutive week they took money in. This is time to the tune of about $1.6 billion. At the top of the group, we saw the Russell 2000 ETF basically taking about $2 billion even. And then we saw iShares Core MSCI Emerging Market ETF take in about $570 million. Now, if we look at the bottom, we saw Spider actually take kind of a big chunk out of their assets. SP 500 for Spider SPY lost about $965 million, and PowerShares QQQ also saw outflows about $921 million as well. So that brings us now to the fixed income side of the market, a little bit different there. So let's go ahead and take a deeper dive on that. For the second week in three, we actually saw outflows, $184 million, but it wasn't really as bad as people might think. It's the fourth consecutive week. We've seen plus side performance, 0.22%. And then we saw that the corporate investment grade debt funds actually took in money, $731 million, and that's the seventh consecutive week they've taken inflows. And government treasuries actually saw inflows of those, only two that actually took inflows, by the way, $17 million. But if we dig down a little bit deeper, we see that the inflation-protected bond funds that we cover basically saw inflows this time only to the tune of about $50 million, but it's the 39th consecutive week they've seen inflows. Now, if we go to the high-yield side, we see that's where people kind of took a little bit risk off the portfolios, redeeming about $383 million. Again, not a big story to talk about in the fixed income universe, but certainly a story to tell nonetheless. Let's go ahead and take a look at what happened on the ETF side of the fixed income industry. We saw for ETFs, we saw $1.9 billion of inflows. This is the fourth consecutive week they've seen inflows. And at the top of the group, we saw iShares iBox High Yield Corporate ETF actually taking about $487 million. Not that big to talk about, but again, worth mentioning, iShares iBox Investment Grade Corporate ETF also took in about $358 million. There's a lot of other smaller funds that took in money as well. At the bottom of the barrel, we saw the Spider Barclay High Yield Bond Fund lose about $73 million. Let's go ahead now and move to our muni bond fund side. And the muni bond fund side basically saw about $90 million net new money come into that group. It's the third consecutive week they've taken in money. And for the third consecutive week, they've had plus side returns, 0.17% return. And national munis were the big winner, taking in $153 million. So we know that probably the single states had some loss there as well. It's the third consecutive week that that group has taken in money. Now, if we dig a little bit deeper on that, though, we might take a look and say, listen, people are starting to move back to the muni bond fund side because of this congressional gridlock. The White House not being able to move its agenda and not doing the tax cutting. So people are finding some interest in moving back into those, and also the belly of the Treasury curve right around the 10 basically lost a basis point as well. So we haven't seen any real rises in the interest rates at this time as well. Let's take a look now at our last group, and that's money market funds. Money market funds, like I said, took in all the money. Second consecutive week, they've taken in pretty big money. $10 billion this week. Taxable money market funds saw about $8.4 billion in inflows, and how that broke out. Institutional investors put in about $5.3 billion. Retail investors put about $3.1 billion. And then if we look at the tax-exempt money market side, we saw about $1.6 billion of net inflows into that group as well. So we don't really spend a lot of time on the money market funds, but we have seen kind of a conservative lurch towards money market funds over the last couple of weeks as the investors are getting a little fatigued as the market goes on. Really no place left to hide, right? Market's high. They don't really know where yields are going to go or interest rates are going to go for bond funds. So I think there's been a little bit, maybe even a little bit of window dressing at month end, but certainly some conservative actions as far as people putting money to work in money market funds. Well, that brings us to the end of our presentation right now. But one thing that came out this morning, I'm sure everybody already heard about it, July non-farm payroll came out, and it came out at 209,000 jobs being created. And that was against the 180,000 that was expected by analysts. So I have a feeling that people are going to get a little bit more nervous about rising interest rates. Obviously, the Fed's probably going to be more comfortable. It's one of the things people keep an eye on. Also, we're coming to the close of, we're in the middle, but getting closer to the end of reporting season. And it has been a very strong reporting season with a little more than half the S&P 500 funds, S&P 500 constituents reporting earnings. Basically, we've seen about 73% beat those earnings expectations. And so that's been pretty good. But again, now they're trying to look back at what the Fed is going to do and see if those tea leaves align and determine whether they're going to jump back into equities again as well. Well, that's it for me, but if you want to do a deeper dive, you can go to our site, www.lipperusfundflows.com. And if not, you can return next week when one of our analysts will talk about the flow trends of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.